Welcome to Finance Weekly. I'm your host, Joyce Wu. Let's take a look at this week's topic. Bullish foreigners pile into mainland China's stock markets. Global investors are snatching up Chinese equities at a record pace, having spent $514 million on average every day in November so far. This comes on the back of unprecedented support measures announced by President Xi Jinping and optimism that the mainland will strike a deal with the US to make peace over the ongoing trade war as this year's G20 fast approaches. Overseas investors are snatching up mainland Chinese stocks at a record pace this month as a result of new support measures announced by Chinese authorities and overall optimism that the mainland will strike a deal with the United States to resolve the ongoing trade war. According to Bloomberg, worldwide fund managers have spent about 3.6 billion yuan on average daily in November so far, purchasing A-shares traded in the mainland through the exchange links in Hong Kong, which is more than any month since 2014, when the program was launched. Foreign interest in Chinese equities has spiked in November after President Xi Jinping and Premier Li Keqiang pledged to ease funding for the country's private sector in an attempt to halt declines in economic growth and the stock market. Overseas purchasing in November is set to overtake that of May, when foreign investors bought Chinese equities worth 2.7 billion yuan on average, just before MSCI added Chinese stocks to its global indices for the first time. The Shanghai Composite Index has recovered 8% after hitting a 4-year low last month, barring its losses this year to about 19%. A sense of optimism over cooling trade tensions between the world's two largest economies has also provided a respite to Chinese stocks. President Xi is set to meet his U.S. counterpart Donald Trump on the sidelines of the G20 summit in Buenos Aires late November to iron out the trade war. We have with us today Dominic Wu, chairman of the Asia Financial Risk Think Tank. Thank you for being with us, Dominic.
Hi, Joyce. Nice to meet you.
Nice to meet you too. Can you tell us what is the main focus and concerns of global investors as they face the current trade tensions between the US and mainland China and the prospects that are shaping the performance of the stock market?
Yeah, sure. If you look at the performance of the stock market this year globally, I would say China A stock market is actually not performing very well, and then followed by Hong Kong, right? Actually, Hong Kong is the best performing market in 2017. If you look at the best performing market, I would say it's only the United States one, right? So actually coming to mind is only one word, is tariff. Okay, because the U.S. trade war between China and U.S. is actually talking about imposing tariffs on a certain export, goods from China to U.S. Right. So I think the investor quite concerned is about which industry we actually have to bear, the impact of this tariffs. And of course, it will actually drive their profits down, right? So I think it's already reflected in some of the stock price of these exporters of China, right? The other thing is that investors also quite concerned is about what the countermeasures from China on US. As we already see, for example, yesterday Tesla is already need to cut down the price of their electric car in China. It's because they see that the demand actually has fallen because also of the tariff imposed by China on the US goods, right? So from the investor point of view, I think they're very concerned is about the liquidity. Okay, but I mean at the moment still with this stock decline, but the liquidity is still abundant. Okay, yeah. So I think it's a good thing. So we don't see there will be an immediate financial crisis. I think the other thing they're very concerned is about the currency. Okay. So if you look at the RMB performance this year, it's already dropped by 5%. Okay, so I think it's one way is to compensate the effect of the tariffs. Okay, but however, it will also affect the pricing of all these China assets, right? Yeah, for example, in the bonds area or in other asset class. Okay, so this is I think a concern of the investor. The other thing is that this U.S. and China trade tension, right, is already spreading out, to the other countries. Yeah. So because China actually is the biggest importers of commodities as well as other goods, from other countries, especially from those emerging countries. So their exports are also quite affected, and so do their currency, right? So this year we do see the emerging country have suffered quite a lot of stress, and actually both in terms of their capital market and also in terms of their international trade. Yeah. To me, maybe we need to really take a closer look. It's about the contagion risk, okay? Because nowadays investors are quite, I would say, sensitive, right, on all this political talk, okay? So the measure affects, their investment sentiment. Because in the time of uncertainty, investors will become more prudent, okay? They will actually hold more cash. Just wait to see what will happen, right? Mm-hmm. So if this kind of uncertainty continue, they may actually, need to adjust, their expectation on what we call the risk premium, okay, of all this asset class. So given that the risk level increase, they actually demand more higher return, right? So if some of the asset classes are not well performing, they may actually need to reduce some of their portfolio holding.
As we all know, the president is going to meet Donald Trump on the sidelines of G20 next week in Argentina. Can we expect a deal, and what are the possible outcomes of that?
I'm glad to see, these two friends eventually meet again, right? Okay. So when it comes to the political scene, it's very hard to predict, the outcome, right?
Sure.
So there may actually not be one deal. And I do believe there will be an ongoing, a series of negotiation. Especially, the scale of the problem is very big and also very complex, right? So recently, the U.S. also announced the Chinese government already approaching them, already have some kind of suggestions, okay, how to come up with some kind of interim, agreement, right? It talks about more than 140 items, okay? Yeah. So I think, if you look at, from the interest perspective of between the two nations, I think they actually have a very strong, willingness, right, is to come up with an agreement, okay, is to continue this kind of trading partner relationship. And actually, maybe more concern is that because of these international trade tensions, actually the effect may be also, being spread, to the other area, like for example, investment area. That both the two countries, right, need to also agree, okay, about reduce the barriers of the, for example, mutual investment in each country. I think China is actually more now open up, right, welcome U.S. company to make investment in China. So hope U.S. will also be more open, for Chinese investment to help them to boost up their economy as well. Yeah. I think the other thing is that apart from financial terms, they also need to talk about technology, right? So I think recently U.S. government have come up with a list of the items that, especially on the technology side, including high technology, artificial intelligence, that they impose restrictions on export, right? So actually, this will have some impact, on those trading partners, okay, or those emerging countries, which will actually rely on U.S. technology, actually to drive innovation and also develop the new product. Yeah.
Mm-hmm. Global fund managers have increased asset allocation in the mainland to both stocks and bonds. What are your views on this trend?
Yeah. Actually, this trend has been seen, since last year. Okay, I think it's very apparent, after the China A stock, and later is the China bond market also be included in the MSCI index, and also other bond leading index as well. So nowadays, in the investment management field, right, the investment manager, some of them already follow this passive investment strategy. They need to follow all these kind of index. So it's inevitable that they need to increase their assets allocation to the China capital market, right? To be frank, if you look at the types of these investors, right, they are more kind of medium to long-term investors. Mm-hmm. So they really value, those company that can distribute high dividend, have a high quality of assets and very stable. Of course, they also want to seek some growth, right, on this kind of stocks, right. But however, the investment managers also have some concerns right now in the China capital market. Despite that, it's being more open than before. First of all, some, for example, administrative measures we may not be meeting those international standards, right? So I think China is also changing it, right? So, for example, some foreign investors complain about, the overuse of the trading halt of the listed stocks in Shanghai Stock Exchange, okay? Yeah, because of the maybe regulatory inspection or because of the normal, exchange, surveillance control, right? So, however, maybe from the perspective of the foreign investor, it may actually affect, their normal operation, okay? There are also other things, for example, like the investment quota, okay, on the QFII and the RQFII, and also those FX control, right? So we still have a different RMB, what we call CNY and CNH. Also, this also incurs some kind of FX risk, right? The other thing, the investment management also very concerned is about the capital gain tax, okay? Because for the Stock Connect, when it just opened, the government actually allows some kind of a concession to, on this capital gain tax if you're the foreign investor holder some Chinese portfolio, right? So actually, it may come to a kind of expiry. So the market also watch to see, what's the policy, okay? But having said that, we do see the China capital markets more opening up, right? So early this year, they actually allowed foreign individuals residing in China to open account to trade a stock, okay? They also very welcome, foreign investors, especially asset management firms, to set up their wholly owned subsidiaries in China. I mean, just recently, right, there's an announcement that, more than 20 global asset management companies had to form an association in the Lujiazui area of Shanghai. So it actually is the first time we see, right? So with the more kind of increasing interest of the foreign investor in the China capital market, it will actually help, to go, the market in a more healthy and more kind of a structured manner.
As we all know, the mainland is currently experiencing a rebalancing exercise, moving away from fast growth to a more substantial quality growth. And the government is committing itself to structural reforms. What are your views on this? What are the opportunities and risks involved?
Actually, China has always, committed to reform, right? Okay, so over the past few years, we do see the supply side reform actually have achieved, several, deliverables. Okay, we do see, the excessive capacity has been reduced. We do see some deleveraging of some of the hot industries or excess capacity industry. We also see, the cost of doing business is also declining, okay, which actually done a very good foundation for the transformation of the economy. So actually, China wants to overcome this what we call the middle income gap, right? Moving from this tier 1 now to tier 2, and from tier 2 to a tier 3, or what we call the tertiary industry, service industry, high-tech industries, as well as eventually also migrated to what we call the tier 4, the innovative style or wisdom style, industries, right? It's actually require a lot of investments in research and technology. And actually, China is already top, in terms of the spending on the R&D, right? So I think the other thing is that China actually want to stabilize some of the, I would say, to contain some of the risks. For example, to stabilize is the employment, okay, unemployment. Stabilize, the concerns of the fall of the export, okay. Stabilize, the concern from the foreign investors. Also, to I would say to improve the internal infrastructure investment. I think more important is that to manage market expectation. Okay, so already we can see that the foreign investors actually appreciate these kind of measures, and we do see the China economy is getting stabilized, right? So if you look at the RMB, it's actually a little bit stabilized after some some decline, okay? But it's also healthy, for the ongoing development of the country, right? So I think you're right. We're actually shifting from I would say a very fast growth more to a kind of sustainable, good quality growth, and more focus on environmental protection, okay, more on the benefit of the people, and also more on the sustainability of the social responsibilities, and also more like a high technology, right, leading us to overcome this middle income gap.
What are the trade tensions' impact on the European market and in European cars in particular?
Yeah, so this trade war, right? I think started by US, right? It's not actually it's very fair to everyone. So first with Canada, Mexico, and also China, I think they still have a legal say with the European Union, right? So China also, US is also threatened actually to impose tariffs on those European cars, raising it to 25%. Okay, they already imposed tariff on those steel and other metal products, right? So we do see the response from the EU is quite severe, okay, and they say they will take some revenge, right? But actually, from the perspective of two regions, talking about North America and also European Union, it's more like a negotiation, right? So I think they need to continue the discussion and come up with some kind of agreement between the two regions. Of course, from the US perspective, they see that they also have a kind of a trade deficit against the EU, right? So and they also welcome EU actually to also invest more in the US, okay? Yeah, so actually to reduce the trade deficit, okay? Yeah, so yeah, I think this is actually setting a kind of a new rule of the games, right? So, and I mean the EU also, because at the moment they also have this the internal issues, like the British exit, okay, and also the popularism in EU actually is growing, okay. So I think the EU also have faced some difficulties. Yeah.